Okay, welcome back. Today we're doing a deep dive into a really fascinating idea from Warren Buffett. It's his 20 punch card rule for investing.
Right. It sounds simple, almost like a gimmick, but the thinking behind it is, well, pretty profound.
Exactly. We've looked at some great sources on this, and our mission here is really to unpack it for you, find those aha moments in Buffett's maybe counterintuitive approach. So let's start with a core concept. Imagine, like, literally you get a physical card, just 20 slots on it.
20 punches.
20 punches. And each one represents a single investment decision for your entire life. You punch it, that's it. Gone forever.
Yeah. And the impact of that limitation is immediate, isn't it? It forces you to completely rethink how you invest.
How so? What's the gut reaction it forces?
Well, it shifts everything from quantity, lots of trades, chasing tips, to absolutely uncompromising quality. You only have 20 shots, so each one has to really count.
So it's about extreme selectivity.
Totally. Buffett actually said something like, I could improve your ultimate financial welfare by giving you a ticket with only 20 slots. Because you'd have to think so carefully. It ramps up the due diligence massively.
Which feels, completely opposite to how things often work today, right?
All right.
With trading apps, social media hunts.
Oh, absolutely. You've got constant noise, FOMO, fear of missing out, pushing people to jump in and out of stocks. Young investors especially, maybe they open a demat account and just flutter around.
Often losing money in the process.
Often, yes. This rule is like an antidote to that. It forces a slower, more deliberate pace. You're not trading, you're investing in businesses.
Businesses you understand, presumably.
Exactly. Fundamentally strong companies, solid management, and crucially, you're planning to hold them for a very long time. It really brings home that Buffett quote about the stock market being a device for transferring money.
From the impatient to the patient.
Right.
The card basically forces you into the patient camp. Okay, so if you're committing to only 20 lifelong picks, how on earth do you choose them? What's the, Buffett checklist for making a punch?
Well, his principles are famously simple but hard to stick to. First, know your circle of competence. Only invest in what you actually truly understand.
Which means saying no a lot.
A lot. Second, find moats. Look for those sustainable competitive advantages, strong brands, market dominance, that sort of thing. Things that protect the company.
Okay.
Makes sense. What else?
Third, buy cheap. Or, maybe better put, buy at a fair price. Don't overpay no matter how good the company seems. Patience again.
Right.
Fourth, think long-term. Really long. Will this company likely be thriving in 10, 20, 30 years? And finally, echoing that patience point, wait for the right pitch. Don't feel pressured to swing at everything.
It sounds like a huge undertaking just to find one, let alone 20 over a lifetime. But let's talk about the potential payoff. Can we put some numbers on this? What could 20 really good decisions do? The math is actually pretty startling. Let's say someone starts young, maybe 25, has a 40-year horizon. They make just 20 investments, maybe Rs 50,000 each, spread out over that time.
Okay.
And let's assume a reasonable growth rate, say 12% a year, which is roughly the Nifty's historical average. By retirement age, that could potentially grow to over Rs 9 crore. It really highlights how fewer well-researched, high-conviction bets can massively outperform just, spraying money around.
9 crore from just 20 specific investments. That's powerful. But is it just about picking those 20? Are there other things you absolutely need alongside this strategy?
Oh, definitely. Two critical things often get missed. First, you need a cash cushion. Always.
Why cash?
Because markets go down, sometimes drastically. Having cash-ready Buffett keeps billions lets you buy those great companies you identified when they go on sale, when everyone else is panicking. Maybe aim for, say, 10% of your portfolio in something liquid.
Got it. Ready to deploy. And the second thing.
This is maybe the hardest part. Learning to say no, really internalizing it, resisting that constant temptation to jump on the next hot stock or IPO.
That FOMO again. It's hard when everyone seems to be getting rich on something you missed.
Exactly. But with only 20 punches, you can't afford to waste one on a maybe or a gamble. It's far better to miss a few winners than to punch your card for a loser that didn't meet your strict criteria.
So wrapping up, this 20 punch card isn't just some quirky rule. It's really a whole philosophy. Discipline, patience, focusing relentlessly on quality, making every single decision count.
That's it perfectly. It forces a level of commitment and thoughtfulness that's rare.
Which leads to maybe a final thought for you listening. Where else in life could this 20 punch card mentality apply? Think about it. Extreme selectivity, focusing only on what truly matters long term. beyond investing, where could that kind of focus dramatically change your outcomes?
That's a great question to ponder. Really makes you think, doesn't it?